What's up, everyone? Dalton Grados here, and lately I've been getting the same question from several of my friends, all on independent occasions, where I've gotten the same question of, hey, I want to start investing. How do I even begin? What do I even do? I'm a nurse, I'm a teacher, I'm an engineer. I don't know anything about this stuff, stocks, bonds. Even where do I even go to open up an account to begin investing? And so I've been getting the question several times that I decided to go ahead and just make a brief introductory video to this, and hopefully it can help you out. Now, this is a good time to say that I am a licensed professional when it comes to this stuff, but I'm not your licensed professional, and none of this is to be taken as financial advice or any recommendations. We don't make any recommendations or advice here, just education. So hopefully it will help. So first, let's start with the boring stuff. I promise we'll get to the exciting stuff in a little bit, but types of accounts, because people have been saying, what account do I even use? So first, a brokerage account. So a brokerage account is a type of investing account that you will open independently. You can do this, a lot of times you could do this through your bank. So if, like, Bank of America has Merrill Lynch, so you could open up the Merrill Lynch accounts for the investing side. Chase has JP Morgan. And there's many others too, Fidelity, Schwab, many others. Even the apps like Robinhood and Webull, you can open up an independent investment account or a brokerage account. Now, this will be not a retirement account. This is the only non-retirement account that we're going to talk about today. Just your independent investing account. It's not meant for retirement, so there's no limits on, your deposits, your withdrawals, your trades. You have unlimited access. It'll be self-directed, so you're making all of the decisions associated with your brokerage account. And they will be fully taxable. So there's short-term and long-term capital gains when you're talking about buying and selling stocks. So just real quick, short-term capital gains is if you buy and sell in less than a year, then that will be fully taxable in a brokerage account at the short-term rate, which is going to be basically the same as your income tax. Long-term capital gains are you buy and sell, but you own a position for longer than a year, and that's much lower tax rate, about 15%. So this account, brokerage account, it's your account. There's no limits as far as like when you can withdraw, but you're going to be fully taxed. Next is going to be your 401k. You might have this through work. So it's a retirement account. It has restricted access. So there's going to be a 10% penalty plus income tax if you withdraw any funds before age 59 and a half. That's going to go for all retirement accounts, whether it's a 401k, IRA, or Roth IRA. And the 401k, again, could be managed by your company, so you might not even be able to have a say in what it's invested in. But 401ks are great because most likely you're getting a match from your company. So, I would encourage everyone to contribute at least up to the company match, because it's literally free money from your company being invested for you. So that's a 401k. Next, we have IRA. Essentially the same thing as a 401k, but it's just an independent retirement account, so it's self-directed. You own it. It's your account. And if you have 401ks with a previous company that you're no longer with, it's a good idea to look at how you can roll that into an IRA, which is your independent account. So there is a tax deduction here. So with an IRA, just like a 401k, any contributions you make to the account are a deduction from your taxes. But when you go later in retirement to withdraw from the account, that's when the taxes will hit. So you save on taxes today, you defer them to later when you go to withdraw. A Roth IRA, basically the same thing as an IRA, but so it's a retirement account, self-directed, but there's no tax deduction today. So you put in your after-tax dollars in today, but it's going to grow, and when you go to withdraw, there's no taxes. So you pay the taxes today, and you don't have to pay them later. Roth IRAs are great because typically when you are going to withdraw from the account, it has built up over years and years and years, and hopefully you've grown and made lots of money. And if you get to not have taxes on the big amount, that's better than having taxes on the small amount, or not having taxes on the small amount. And with a Roth IRA, there's limited contributions. So I believe right now in 2024, they might have raised it actually, but it was around $6,000 a year. You can't contribute more than $6,000 a year for a single. I think it might be 13 for married. I'm not sure exactly on the figures, but there's limited amounts to what you can contribute. And if you make over a certain income level, I believe it's 120 or 125 grand a year as a single individual, you are not eligible to have a Roth IRA. So again, bringing it back to the basics, these are your types of accounts. There's more accounts than this. There's advisory, there's trusts, there's all kinds of different accounts that typically, if you had them, you would probably be working with a professional already. These are basically the main basic types of accounts. Again, independent brokerage is going to be your independent investment account. The rest are all retirement accounts, and so we just went over the differences between them. Okay, now for the fun stuff, stocks and bonds. So, what are stocks? A stock is an ownership in the company. So you are literally buying a share of ownership in a company. Now there's two ways you can get paid. You can get paid in dividends or capital gains. So sometimes companies will pay a dividend which is essentially a share of their profits, and that will be in addition to owning the stock. So you own the stock, you don't have to sell it, and they will just pay you a dividend. That's basically you're participating in the profits of the company, essentially. That's what a dividend is. Capital gains, very simple. You buy low, you sell high, and that's how you made your money, right? So you are participating in the company's success and their failure, right? So there's more risk and more reward potential. If you were invested, so right now in 2024, if you have been invested in NVIDIA for a long time, then you've probably made a lot of gains, but you also took the risk. And if you had invested in Intel, which is also a similar type of company, a chip making company, but if you had put that money in Intel instead, you'd probably be down right now, actually. So you're taking the risk on the company and participating in their success and failure. Now, the great thing is you can buy a fund that is, or an index that is basically a basket of lots of companies, which we'll get into later. But basically, you don't have to buy, individual stocks. You can buy just one thing that is a basket of a ton of stocks, and that's a great way to spread the risk. And there's lots of different types. There's growth funds, which are more the riskier companies. You have value, which is more like the staple companies. You have large cap, which is basically the size of the company, large cap being your Apples, Amazons, big companies. You have small cap, smaller companies. You have US companies, you have international companies. So there's all sorts of types of funds that can get you exposure across the board, right? Now, what are bonds? Bonds are essentially debt. So you are lending money to the organization. So instead of in the case of a stock where you are owning a piece of the company, with a bond, you are lending them money and they are paying you back a certain interest rate. Now, you typically have government bonds where you're lending money to the government. These are considered the safest investments because it's backed by the authority of the government that they're going to pay back your money. But you can also lend money to a corporation and buy corporate bonds. And they will pay you back oftentimes a little bit higher of a percentage, but you're taking a little bit more risk because it's backed by the creditworthiness of the issuer. So bonds, you get paid back a promised percentage. It's less risk, but also less reward. So it might be just a fixed percent, say 5%, 4% bond. But it's basically guaranteed. But that guarantee, the risk is in the creditworthiness of the issuer. So that's why government bonds are typically considered the safest, AAA rated. they're not going to default on their bonds. And then companies, you could take a little bit more risk and get more reward there on the bond section. So, and you'll typically see in the ratings. So, there's AAA is the highest rating, then AA, A, and then you get into the Bs, and then below triple B. I should have put this as actually a bullet point in here. It's good to know on the bonds is that if the ranking is below BBB, triple B, it is no longer considered investment grade. And those used to be called junk bonds. Now I think they're called high yield bonds, which sounds a little bit more appealing. But basically, you're taking more risk because the credit worthiness, just like you have a credit score, companies and governments have a credit score. And so if you're going to lend money to someone who's not as credit worthy, you're taking more risk, more risk. It's always risk reward, that's what you always got to think of. Anyway, assessing your risk tolerance. So, okay, we've learned about stocks, we've learned about bonds. What do I buy? Well, I would ask you to ask yourself, what is this money for, and how long of a time horizon do I have? So when you're thinking about, okay, I'm sitting down, I'm going to open my brokerage account, I'm going to open my Roth IRA, I want to start investing. What is the money for? How long of a time horizon do I have? If you have a longer time horizon, you can afford to take more risk. Drawdowns are okay. So look, if you're in a retirement account and you're 27 years old and you're not going to touch that money till you're 65, then you should not be concerned if the money is going down, right? If the stock market's going down. Drawdowns should be okay because look, you don't care about what this money is doing today. You have a long time horizon. So you could take those risks into riskier stocks because over the long term, they should go up over a long period of time. And you should be still diversified, but you could take more risk in that asset, your asset allocation. Popular method that's always advised to people with a long time horizon is to dollar cost average over time. What dollar cost averaging is just basically no matter what the stock market's doing, you're just putting money in every week, every month, whatever the interval is, but you're just continually putting money into that investment, and you're going to get, sometimes you're going to buy it when it's high, sometimes when you're going to buy it when it's low, and it'll average out over time. You're just making your consistent contributions over time, and that is ideal for long-term investments. Now, if your goal is income, so this might be people that are in retirement, or maybe you got a big lump sum of money. Maybe you were gifted $5 million and you're like, I don't want to take any risk with this money, but I just want it to pay me a consistent income from the interest. Then you might be more on the bond side of things because that will pay you a consistent percentage and they're generally safer. They don't have as much exposure to volatility. But if you were sitting down with an advisor, they would go with you through like your risk tolerance and determine, what sort of setup makes sense for you. So are you more aggressive? That's going to be more the bond side, longer term horizon. Or are you more conservative? You don't want to take as much risk. You want to be in safer investments. And typically there will be, a spectrum of this where you might have your portfolio might be 100% stocks, that's more aggressive, 0% stocks is more conservative, and everywhere in between, 60-40, 60% stocks and 40% bonds is a little bit more balanced, and everything in between. So the goal for this video is just to kind of introduce you to these concepts. So what do I buy? Okay. So again, like I said, it's based on your risk tolerance, whether you'll have a mix of stocks or bonds. Maybe if you have a super aggressive, you won't own any bonds and it'll just be all in stocks. But generally you'll have a mix. So for the stock side of things, low cost index ETFs. So I mentioned before about stocks, and you can buy these funds that's basically a basket of stocks. And we have indexes as well. So a popular index you might have heard of is the S&P 500. The S&P 500 is in the United States is the 500 largest companies. And what's great about the S&P 500 is the 500 will always be the 500. So if a company fails and goes bankrupt, it will be dropped from the S&P, and another company, the next best company on the list, will replace it, and then that'll be in the 500. So you're always going to be invested in the best 500 companies in the United States. Now look, there's many more funds, there's many more indexes other than this. The purpose of this video is just to get a general introduction, get you some things to think about to then go further research. You might have heard of mutual funds, but now most people are going more towards ETFs. ETF is exchange traded fund, just because they're typically lower cost, there's lower fees associated with them. And so these examples I gave for the S&P 500, SPY, IVV, and VOO are all examples of S&P 500 funds. These are the tickers for them, where you will go in and type in these tickers. And there's many, many more. Again, there's no recommendations here that you can look into what funds you want to buy, but these are just examples to start with. So you would go in and say you want to buy IVV, you would buy that ticker, and that will be your S&P 500 basket in one ticker that you own, and you buy it and sell it just like a stock. But it's a great way to own a big basket of lots of stocks all in one. Okay, so more examples here. Say you want to invest in the NASDAQ, which is QQQ. There's many other funds. VUG is also a growth stock fund. It's basically the NASDAQ, similar to the NASDAQ. And then VTV would be value. So you got your growth stocks, value stocks that I mentioned earlier. These would be just examples. I'm not saying go out and buy these. Do your research. There's many other funds out there, but these are just examples of different ETFs that exist. Okay, and then you might have bond funds. So you can also get these in the form of ETFs, or you could just buy bonds directly. But you have your government bonds, and then high yield or corporate bonds that we talked about earlier. Just some examples of some government short-term bond funds, VGSH and JPST. Again, I would encourage you to look more into them. There's a whole universe of funds out there that can get you the exposure that you need. Now, if you want to make it super simple and be totally hands-off, there are target dated funds. So especially for your retirement account or even brokerage account, again, going back to that time horizon, what is the money for? You can buy target dated funds which auto allocate based on year. So Vanguard has these, BlackRock has these, JP Morgan has these, Franklin Templeton. There's many different companies that do this, but essentially you pick a year. Say it's gonna be a retirement fund, and you're gonna retire in 2050. So it'll be a target dated fund for 2050, and it'll be more invested in stocks today. And as you get closer to 2050, it will adjust the allocation of stocks and bonds as you get closer to that end date, to basically take you from riskier to more conservative, and it will adjust your percentages of stocks and bonds. Typically your 401ks that you have with your company are most likely already in one of these target dated funds. So this is all I had for today. Again, just wanted to get a basic, simple introduction and give you just some ideas to begin thinking about how you want to start investing. Again, none of this financial advice. Go out and do your own research. Maybe seek an advisor if that's appropriate for you. But hopefully this was helpful. Let me know in the comments below. And if you really want to get more into the stock market and follow what's going on, you could subscribe to this channel. And maybe if there's demand, I'll make more videos like this, which will just continue the conversation of, how do we begin investing. So thank you for watching, and I'll see you guys next time.